Hey, welcome back to the Exit Teams podcast, where business owners and their advisors get real practical insight on how to build a team of advisors, maximize value, and exit on their own terms. I'm your host, Bob Tankisley, author of Exit Teams, Build a Team of Advisors for Your Business Sale to Get a Higher Price. You can find that book on Amazon. Just start typing Exit Teams, and it should be the first hit. And don't forget to check out all the great content we keep building at exitteams.com. Whether you're years away from selling or thinking about an exit now, this episode, I assure you, is packed with must-know tips to help you take advantage of opportunities while avoiding costly mistakes. Today, I'm joined by an expert in the world of community banking, my good friend Ryan Earnest. Ryan is president and CEO of First National Community Bank, with branches all throughout North Georgia. In his role, Ryan leads the bank's strategic growth and community banking initiatives. With a banking career that began in 1996, he joined the organizing team of Heritage First Bank in 2002 and became president in 2008 and was named CEO in 2017. Following the merger that formed FNCB in 2021, he assumed leadership of the combined organization. And beyond the bank, Ryan is active in both industry and community leadership. He serves on the board of directors of the Georgia Bankers Association and was named president-elect of the Graduate School of Banking at LSU. Locally, he chairs the Floyd County Development Authority and serves on several nonprofit and economic development boards. A graduate of West Georgia and LSU's Graduate School of Banking, Ryan is known for his commitment to banking at a community level, workforce development, and long-term economic growth. Hey, Ryan, welcome to the show. This should be a great conversation. I know, one that every business owner listening or watching should get a lot out of. I mean, seriously, who doesn't need to know what smart business banking actually looks like? I learn more about banking from you every time we talk.
Well, thank you, Bob, and I appreciate the compliment. It's great to be with you this afternoon, so thank you.
Yeah. Hey, let's jump in and start talking about access to capital, and sometimes in a good way, sometimes a growth constraint that business owners might be facing. From your perspective, what separates businesses that can easily access capital from those who just struggle just to get financing?
Well, that's a great question, Bob. And one of the things that we're going to be looking at here is, does the borrowing entity or the guarantor of the proposed loan, do they have a realistic business plan? And do they have the numbers that will back it up to make it realistic? Can they execute that plan? And do they have a complete financial package to back those two things up? So that's really what separates a business that can easily access capital from one that may struggle.
Yeah. So naturally, that makes me think of what some of the most common reasons that a strong business might get declined or, have less borrowing capacity from a particular lender.
Indeed. And that's really what separates the ones that have an easy time. You think of your bank as a business partner, if there's a silent partner. So what you're trying to establish is that relationship, that mutually beneficial relationship. So the more your banker can learn about your business, how the revenue is turned, how quick you turn that revenue, and how the loan can be repaid from whether it's the primary repayment source of the business or other means, that's where the separation really begins to take place. And those who struggle typically have not thought the plan all the way through, or they've not become familiar enough with the resources that are available out there to put together a good business plan that features income revenue pro formas, that features capital injection points. It gives all the forks in the road as to where the next big decision may have to be made. And then and if you make that decision, what does the next 5 to 10 years look like? What's that immediate runway look like to be able to know what that is going to be going forward?
So when a bank business owner first comes to you, you guys are thinking, okay, we're going to try to bank them now, lend money if that's the case. But you're thinking, sounds like, I mean, you used the term business partner a few minutes ago. You're thinking 5, 10 years down the road. You guys are already thinking, how can we get them to be an even stronger borrower? How can we get them to a better position than they are when they meet us right now?
Yeah, absolutely, Bob. And that's where the magic happens in the relationship. If you're working with a banker that's going to be able to take an interest in the business, understand the business, and be able to help with leveraging their experience back into the total relationship, that's when the business owner can rely on that banker as an advisor, as a silent partner, so to speak. And again, that's where the leverage comes into play. I may have worked with a borrower or businesses over the years that are doing the exact same thing that your business may be looking to get into. I may be able to help you with understanding where the pitfalls are or where the capital injection needs may be relative to the experience that I have. So, let your banker lend you their experience in the leverage of that relationship, and you'll find that they can be a really good part of the return on investment for you long term.
Yeah. So let's get a little granular here. Let's talk about what lenders really look at. When a bank evaluates a business for lending, are there two or three or maybe five factors that matter the most just beyond the financial statements?
Yeah, it's really, you're exactly there on point there. The things that are really going to be the differentiator in success. Do you have a strategic plan that is believable? It's executable, and it does have either a track record if it's an existing business and you're just looking to take it to the next level, or is it something that's new? Do the pro formas make sense? In other words, is it logical? Can all those things work? And once you have that, there's a level of transparency, and the knowledge of the overall project is really where that begins to take hold. Again, just realistic expectations is really what a banker is going to be looking at in evaluating whether or not it's going to be something that's investment grade or investment quality. Because at the end of the day, your banker is going to be providing that capital via debt. Therefore, they're going to want to know what the return is for them. When you set an interest rate in terms, the bank already knows his or her somewhat the return on investment that they have if everything works to plan. But as long as the borrower knows that as well, that's when the true partnership takes hold. And that's when the real traction, so to speak, takes hold relative to the future success of the business.
So when you're talking with an owner for the first time, you're getting to understand their company. I'm sure there are some financial or operational signals or indications that immediately give you confidence or
Yeah.
in some cases concern about a borrower. What is some of those so that business owners can get ahead of that and maybe fix some things that you guys might or other banks might want to wish weren't in place in that business. What would you guys want to see that's been fixed or looking really good in a business to give you confidence?
Well, first off is the ability to repay the debt that they're considering.
Top of the list, I'm sure.
Top of the list, absolutely. But again, getting a little more granular in that, does the borrower or the borrowing entity, does it understand how it turns its profit? Does it, a metric that you may look at, do they understand what their quick ratio is if it's in a commercial lending? In other words, how quick can they turn their inventory to create the revenue necessary to create equity in the company, debt service of the company, as well as compensating its work staff in a competitive nature so that the longevity of the business is set. So those are the type of signals you can tell in a first meeting in the first few minutes if this is a viable project or it's going to take some work to get it to be a viable project. And not every project is bankable, but then again, not every project needs banking. So you have to look at it from that perspective and think in terms of what that looks like. And there are a lot of times that the relationship, Bob, starts with just an advisory session. A proposed borrower will come in and say, I'm thinking about doing this. What are your thoughts? Have you seen this before? And you begin to work through an advisory mode as opposed to let's collect a financial package and make a loan in the next 30 days. It may
Mm.
take a year or so. It may take 2 years or so. And there are a lot of resources available to borrowers out there that they can go in and have advisory data provided to them to help them make more of an educated decision on what they're looking to do. Your banker should have access to a lot of those things, but third party availability is abundant these days. So, having said that, looking at those types of things there is going to be those are the signals that we're really looking for from an operational perspective that give us confidence that they've thought about it and it's realistically they're thinking about it and it's not more of a dream, it's more of a reality. And here's how I'm going to
Mm.
do this. And here's why I need you to be involved, Mr. or Mrs. Banker. This is why I need you to be involved. And this is what I plan to do with your money. And this is how you'll get it back. And this is in the rate of interest that we negotiate to is mutually beneficial for the risk that we're presenting to you relative to the risk that you're willing to take on to fund our partnership.
In a way, I just thought of it this way. In a way, it's like in some cases, you're preventing them from making a mistake, you know,
Yeah.
borrowing too much, getting in over their head, so to speak. You're setting them in an advisory role. You're setting them up for becoming a better borrower and a stronger business later.
Yeah. Well, using the data that's available to us to help them with understanding what they're up
Yeah.
against, because that's how we'll underwrite the transaction to capture the level of risk that is acceptable to our shareholders. And
Yep.
as a result of that, then we'll vest that knowledge back to them. Then they make a decision on whether it makes sense for them, whether they can create the same return on investment. And so from that standpoint, yeah, when I say advisor, it's more of a team-based approach and that type of thing. We're not necessarily keeping them from making those decisions. We would, they can do those things on their own. What we want to be able to do is provide the tools for them to make that educated, more of an educated decision on does this make sense for us? And even if it doesn't make sense for the bank, it may make sense for them to go ahead and go forward with other means of capital that they can procure for themselves and still be a successful business. While we're just helping, when I say advisory, it's not necessarily we're saying don't do this or definitely do this. Let's present the facts for them, the knowledge that we have, the products that we have, and if it fits, then that's great. Let's go for it. If not, what does it take to make it fit? And how can I, with my experience as the banker, be able to adjust a package or you're just missing here. Let's get this fixed. Let's get this
Yep.
so that you understand how this may impact your business and the business's cash flows going forward so that it's not a surprise to you at a time when you're really gung ho and you're going for it, and all of a sudden this hole opens up, and it could be a natural occurrence, and nothing that has anything to do with a bad business or a bad business plan. It's just that where the ebbs and flows of the cash flows, and do you have the knowledge to know where those things are? And that's
Mm.
that's really what your banker's going to be able to point you to. We would not know those things naturally, and we would not represent ourselves in being able to say that. What we would want to do, though, is point them to things that, do you understand the seasonality of the business? Do you understand how you get through the seasonality of the business? What are your short-term working capital pitfalls, and how do you fund those and keep going? And not all businesses, follow a straight horizontal line. They're up and down. So as a result of that, how do you make a straight line through the up and down?
Yeah. No, that's all very well said. Appreciate that distinction. So I imagine sometimes business owners are surprised to learn about how banks look at risk. No?
Yeah. Yeah.
Yeah.
Absolutely. Go ahead.
What
Yeah.
what do you what do they tend to be surprised by the most?
I think they're surprised by the number of questions that banks ask. Why
Okay.
are you asking that question? Why is that important? Why do you need
Yep.
this piece of information? Why so much information? And the underlying reason, Bob, is plainly this. We see ourselves as a silent partner in your business. And as a result of that, the only time we have an opportunity to measure what that risk is for us, to measure what that business plan should be, how it looks, those types of things, to understand where the cash reserves are for future payments if there is a slowdown, and all of those things, or if there's an issue with the credit, or an equity issue, or a issue with the collateral. These are the only times that
You
your
have
banker
that
will have an opportunity
opportunity is
to ask that, because
up
after the
front.
loan funds, it's really it's to the borrowers. They're on their own as far as those types of things go, because we've already made our decision, and they may come to us and say, "What do you think?" And we can offer what we think, but we're not running that business and would not ever try to insert ourselves into that business. That's the wrong place for a banker to be from the perspective of helping them run their business. We're more of a silent partner that's out of the way. So I think the most surprising thing I hear from borrowers is why you ask so many questions, and why do you need all this information? And it's all the same information that you had likely considered when you put your business plan together. Just think about it from the banker's perspective. Well, you're asking me to invest in your business, and whether I'm your partner
Yep.
whether I'm your partner or not, from the standpoint of being on the sign outside or whatever, we're still very present in your in the DNA of what your company or whatever your venture is. Therefore, we're going to ask a lot of questions to that degree, just to make sure that we cover our enterprise risk management uh, is covered adequately there, so that we can be everything for that borrower they need for us to be and want for us to be.
Yeah. No, that's very well said. So, in terms of financial discipline and financial reporting, because I know from an exit standpoint, that's where buyers tend to go to first. That's their screening tool. And I've always viewed financial statements. I've been a CPA or in the accounting world since '91, and I've come to view financial statements as a report card on what management has done with shareholder resources. And of course, in closely held companies, management and shareholders, they're one and the same uh, in many cases. So in terms of financial statements, how important is the quality and the consistency of that financial reporting when a bank's making lending decisions?
Extremely important, Bob, extremely important, because like I said earlier, it's the DNA of the business. It helps us get a feel for the consistency of what the owner or what the management team has been able to accomplish. So the consistency of the reporting, making sure that's accurate, it accurately captures all of the assets to offset the liabilities that are presented there, and making sure that, from your perspective as a CPA, making sure that if that person is not preparing the statement, if you're doing it on your own, make sure that, and it takes time to do a accurate financial statement. And I've done one for myself in my household, and it's not a lot of fun, but it is a necessary exercise to be able to come to the reality of what I have versus what I have that's leveraged against that. And then the difference of those two is that net worth. And if I'm considering a new business venture or expanding on the one that I have, how does that grow? How does that grow that is supposed to take away from that? So it's extremely important the quality is extremely important. And the quality, it's not how it's presented or how it looks, it's the information contained therein. Is it easily understood? Is it accurate? And does it foot? Does it make sense? All of those things. And when you look at it from that perspective, it's maybe one of the most important things that you can do for your banker, from the standpoint of giving them information that's easy to understand. It fits in line with what you're doing. It's not inflated or deflated. You're not leaving
Mm,
something's important that's out, you know, like having a $500,000 of stock shares in a company may not be important to you because it's much less than what it was when you bought it, but it's still $500,000 worth of cash reserves. It could be converted to cash if you needed to inject it back into your business. So your banker's looking at those types of things with it, whereas that might be an investment you just forgot about, or you don't want to get back to because it's not doing what you thought it would, and you've written it off in your mind. But it's still a relevant part of your overall net worth profile.
yeah. I know a lot of owners, they know all about their P&L statement, their income statement.
Yeah.
Ask them about their balance sheet. There's a few question marks there. Maybe inventory doesn't reflect, current values, AR might be overstated or understated. Liabilities, do we have all the assets on the books? I've noticed over the years, owners don't have as solid a handle on their balance sheets as they do their P&Ls.
Yeah. Well, of course, a P&L is what's making the bill payments. It's going to pay your bills with your income statement. The balance sheet just kind of look around you. I guess this is what we have, and this is what it looks like. But all that to say, that's a very it's the other half of the story.
Yes, it is. So there's got to be some common financial reporting issues that weaken a company's ability to secure financing, right?
Yeah, there would be, you typically look at that. Maybe the most common of those issues might be just inconsistency. Getting back to the first question there, or the earlier question there that you had, inconsistency in what you have there. So you may have a cash reserve of for discussion purposes today, $500,000, and in a year later, that 500 turns into 175,000, and you might have forgotten to include another account. You're working in haste to get the new one done, or what's the real thing? Because your banker's going to pick up all that and say, "Well, gosh, you're missing, a significant amount of your cash reserves just in 1 year. What happened?" Well, I forgot. Oh, yeah, that's right. That's that account at A, B, and C brokerage. I forgot to put that on there. Again, look at the consistency and the quality you were talking about there. So those are some of the most common reporting issues when you go to your personal financial statement, whether it's for the business or the person. Then the other things might be just the making sure that they understand their business plan. They may have said to open up that we would make this product, and it's turned into that product, but a variation of that product, and the pricing on it has changed. So that changes the whole risk profile or a significant portion, better said, Bob, of the overall risk profile. And as a result of that, that could weaken the ability to secure financing because in intra loan, the terms of the business may have changed to the degree whereby it was a necessary change, a good pivot over to something that's a more profitable piece of the business, or the first one wasn't really working out, but experience shows that business owner, if I tweak it this way, I think I can really light the fuse here and do that. And keeping your banker aware of those types of things is an extremely important part of that partnership, just so that when you get to a loan renewal, or if there's some sort of reason for you to revisit that loan from an administrative standpoint, servicing, that your banker knows really what's going on out there. And a good banker will have in his or her portfolio, they'll know a little bit about every loan, just so that if it's brought up in some third party, review or a examination, or even just in general discussion with that borrower, he or she needs to know a little bit about that business to be able to counsel them in the right way.
I've been saying for a long time that the commercial banker should be on the owner's team, not just when it's time to borrow money, but all throughout the business ownership.
Right. A great point. I think that there are three partners every business owner should have that aren't necessarily working day to day with the team, and that's your banker, as you mentioned just a moment ago, a bookkeeper, CPA, accountant, someone who understands the business, how the business flows, cash flows itself, and what does the adjusted gross income going to look like, and how do you impact that? What are the tax strategies? What are the different accounting strategies that you have? And then the third of three things would be a good legal team, a good
Yep.
attorney, someone who can help you with whether it be some sort of employee human resources related issue, all the way to a patent and everything in
Yep.
between there, and that runs a gamut of everything. And I think sometimes a lot of business owners miscalculate how important those two ends of the spectrum are. What the range of everything in between there. But you got these two distinct outposts there, which are two completely different things, but happen in every business.
Yep. Yep. Banker, CPA, and attorney. I couldn't agree
Yep.
more. Very, very
Yep.
valuable team. You
Mhm.
kind of touched on this before, but are there any metrics or trends that a bank expects business owners to understand really deeply before approaching a lender?
Yeah. I would say the first off is if have a deep understanding of the business that they're in, understand who their competitors are, understand where they fit within that
Mm.
base of competition, understand what separates them from that, understand why that's important from the standpoint of being able to fully understand your product base or whatever service you're providing or product you're providing, so that if you need to make adjustments to it along the way to remain nimble, lean, and be able to deliver that product in a profitable way, you need to know how that is so that you can cut where you need to cut, or you can add to where you need to add, or at least move over back and forth where you need to be and remain nimble out there. I think that's the main thing. The second thing is just understand the economic conditions that would govern that business. Understand if you own a trucking company, for instance, or an airline, and you've got a inflationary environment and gas prices or fuel prices are increasing or high or keep increasing, you've got to understand how does that impact my business and what does that look like so that I can proactively direct the outcome of what's going to happen here. So do I need to reprice my product temporarily? Or do I have the cash reserves to carry through that? And is my competitive advantage leveraging that cash position to remain at a certain price point where my competitors are maybe having to go up because they don't have that same competitive advantage? And I think there's where those are some of the metrics or trends that every business owner should have in the back of their mind, is to know how they can differentiate themselves from their competition when out of their control circumstances prevail.
Yeah. Here we sit kind of mid 2026 and tariffs are still an issue. So, to the
Yeah.
extent that a business is impacted by something like tariffs, they really need, great point. They really need to get themselves out of their business and think at an industry or very strategic level. That's a good reminder.
Yeah.
How about let's talk about debt and capital, because I'm sure you've seen where owners have misused debt. Where have you seen that? Either by uh, borrowing too much, or on the flip side, not borrowing enough.
Yeah. That's a great point, one to really expand upon, because I've seen it both ways. A conservative borrower or business owner may underestimate, if they borrow not enough, that they've not fully flexed the ability fully flex the next generational impact of what that capital can do. On the other side, if you borrowed too much, then it dilutes the ability to turn that investment in or really fully realize its potential because it's got so much debt on the company. So how do you understand where's that fine line, that knife's edge where you've got to stand on
Yeah.
to be able to do that? And there's where your team's going to come into play. Your banker, your CPA, and your attorney are going to help you navigate that maze through some of that to help you with making a decision. None of these three entities are going to be able to make that decision for you, but they're going to give you the tools necessary to present facts to you from three completely different walks of the business to say what that might be. Do you strike that balance? I don't know that I've ever seen somebody hit it just on dead on bullseye, but there are people I know that have done that effective enough with a range of error or margin of error to the degree where they come in when they're just right on point. And going back to just a moment ago, we were talking about having cash reserves. If you've not borrowed enough, whether you can dip into the cash reserves and the investment pays that back for you. Or if you borrow too much, you can look at, either leveraging that into another investment to help complement the one you have there, or you can take a look at just paying the loan down and recasting payments and those types of things there. So, you've got to really, take a look at what that can be. I mean, that over leveraging can hurt a business, and what you do with that money. I know a lot, we see some from time to time, you'll see a business owner who will borrow and they'll re-amortize debt that's almost paid off. Let me borrow, as opposed to $50,000 from you, let me borrow $65,000 from you. And I've got a couple of company owned assets that are near amortization term. But if I package it into one, I take a bunch of the smaller things and put them into one big one and re-amortize it, then it works. Well, if it's a depletable asset like an automobile or a machine that's not getting any younger by the second as you use it, then you've backed yourself up in that part of your investment. But having a nice one payment, one bow on top of it does appeal, and you may have overextended at that point and not really know that because it wouldn't be apparent until you're paying for two trucks or two pieces of equipment because one wore out, but the loan still exists. The new one with the new loan exists.
Yeah. Well, this makes me think about, good versus bad, call it dangerous debt, if you want to put it in those terms. But it's one thing to, get your amount of debt correct. But as the debt that you take on, can there be good? Can there be bad types of debt on the books?
Absolutely.
Yeah.
Absolutely. I'll start with good debt. Good debt comes from a well-designed and fully baked strategic business plan with the pro forma analysis attached to it, with the demographic analysis attached to it, with the risk analysis attached to it, and everything that says this is what I'm going to do, this is how I'm going to do it, and is easily obtainable, and what's the right mix of debt into that equation in that pro forma to make it work. So if I borrow on a loan of $500,000, for instance, Bob, and I sprinkle that into that, and that is the catalyst that helps me get from net revenues or gross revenues of a million to a million three, a million four. Well, you can see how you've exponentially
Right.
taking care of the increase in investment quality of your firm, the ability to generate retained earnings or equity, and that's good debt. There, that it serves as a means to an end. Now, on the flip side, what is the dangerous debt you were speaking of? And dangerous debt would be not really having a fully known use for that cash or that debt. It's just that you're looking for a capital injection to have as cash reserves. That's an expensive way to create cash reserves, obviously. And leverage can be good. Leverage is good, as I mentioned just a moment ago, but in this case, unless you fully know what you're going to do with that cash, then you should not borrow that because it does strap the company to a degree whereby it does, at the end of the day, it finds its way to the bottom line. And so, there's some dangerous debt. It's not dangerous in the sense, Bob, that you would not know exactly what you're going to do with that debt.
There it is.
And we see it from time to time. Is there a specific source in use? What am I doing with this? The source is the bank of $500,000. The use is $500,000 to buy a machine that will produce X number of revenue dollars for me at what margin divided back into the cost of the credit. So the opportunity cost is easily quantifiable and it's qualified, and you can say that's good debt. If you're borrowing and letting sit idle, or you're putting into something that's just a complete flyer, part of your business, or a business that is just a flyer type business, then that could be dangerous debt because you're not really in tune as to how you get that back. There's not that equation can't exist to quantify it, or it's not as readily. Or when you do work the equation, is it negative in disadvantageous to the business?
Yeah. Like I said at the outset, I learned something from you every time we talk. That's well put. I appreciate you putting it in those terms. It makes me think that, owners of companies would do well to think like bankers on a regular basis, just from the sheer uh, rigorous analytical process of looking at their business that I know very few of them actually go through.
Yeah,
Yeah.
yeah.
We talk about exit here on the show a lot. So let's talk about preparing for exit or, some kind of partial exit, maybe a partial liquidity event. So when a business is preparing for a sale, it's imminent. We can see it. It's in sight. What financial or structural issues show up that could have been fixed years early? I'm really big on helping owners get ahead of problems before they become visible to a buyer.
Well, great question, Bob. And the answer to that is your when you know there's the exit strategy. If you have a strategic plan, then you know when that exit may or may not be. There'll be an inflection point where you'll know either I'm going to stick it out for another 10 years or I think the 10-year window is here. And as you approach that, you're going to want to look back, 3, to 5 years backwards from that to make sure that your tax returns or any internal documents that you're going to use to leverage to verify and substantiate the value of your company can be backed up by realistic, believable documents, whether they're tax
Yes.
returns or cash flow statements or whatever. If you're a publicly, traded company, whatever means that you use to do that, audited financial statements, these kind of things are going to be the things that you definitely want to be looking at. So if you're a small business owner and you have a business that's able to fund your automobiles and a lot of the expenses that might otherwise be on the personal side, on your personal financial statement as opposed to the business financial statement, and a savvy, business person who's looking to buy will be able to say, well, what extract those out and say, well, those are one-time expenses. What's the real EBITDA here? What do we really have here?
Yep.
As opposed to what's the net income and can I extract those things? But it makes it tough for that acquiring person because if I've got to do some of those types of things, then what else is here that I need to look closer to?
Yes.
And so you develop a credibility uh, with your business, with the documentation of your business
Yep.
there. So if I'm going to sell my business in 10 years, in that fifth year, I'm looking to say, okay, what do I really have to substantiate the value of this company? And that can be the difference, Bob, in a multiple, of earnings.
Yes.
I may be able to get 10 times earnings for this company if I've got a proven reason as to why that you should be able to, as the new owner, continue to make this money, and then they can calculate backwards, from the back, from their time of acquisition backward to say, okay, well then I've got a capital burn of X number of months that converts into break even, and then all of a sudden I'm in the money at what, and then does that make sense for my investment
Mhm.
strategy, my investment profile? And as such, you want to take a look at those kind of things there. But, we've seen time and time again where, you may have a couple of payments that may be better suited for your personal side that show up on the commercial side and somewhat may dilute the overall value of the company in time. But I think that a good strategy is knowing when your exit is, and not everyone has that luxury, Bob. I mean, let's face it.
Sure.
Sometimes there's a sale of a business due to a extraneous circumstance, a death of a wage earner or an owner or a sickness, or just they want to just completely, just retire and get out. And they've not thought it through from that standpoint. There's not enough back there to make that. But I'm putting together the true value of my company has been able to be substantiated, and that could be the difference in earnings multiple of 5 times versus 8 times. And that's real money you could have on the table, or you may leave on the table.
I tell owners often with respect to their cash flow, you can have it now. Sure. You
Yeah,
can run a lot of stuff through a company. You can have it now, or you can have a multiple of it later when
there
it
you go.
comes time to sell.
That's right.
They seem to get that. I'm also glad. I'm really glad to hear you validate what I've been saying for a while, and that is 3 to 5 years of prep time before going to market. Start then at least to start straightening stuff out. A 3 to 5 year window I've noticed does at least two things. One, it allows us to get the owner to get behind making some changes in their company, and we're not asking them to make changes over 10 years of time and burning them out. Oh, this has taken way too long to get my company ready and to optimize my company. The second thing it does is it proves to that future buyer and their provider of capital that, hey, you've made some changes in the company long enough for them to become sticky and create a believable story that the company is what it's being presented as on paper.
Yeah.
3 to 5 years, folks. So a company's banking history, how does that, coupled with the lending relationship, how does that impact buyer confidence?
Well, so, there's a third party substantiator for
Yeah.
that. You could say, okay, Bob, you're trying to sell your business and I'm looking to purchase that. Who do you work with? Who can I talk to that can help me with
Yep.
your business? So who is that? And well, why don't you go down and see my banker? He'll and I'll give him permission to share with you whatever you
I
want to
like that.
ask.
I like that.
And Yeah, and just you can say, well, we hate to lose Bob as a borrower because he's been so good because the business has been such a good business for us, but would you give something to service you? And I can't think of any better endorsement of the business that I'm looking to buy than your banker to say, would you give me an opportunity to make you the loan to buy this business with? Because that says it's a great business, it's a bankable business, it's an investable business, and it's got longevity to it.
Yep. Well, that's I had not considered that before. I may start introducing that into the conversation. Hey, you want further proof that my business is worth buying? Talk to my banker. That's a good
That's right.
insight.
Yeah.
Most business owners, unfortunately, probably say, "Please don't talk to my banker."
Well, yeah, if your banker's doing his or her
Job,
job, then
that's it.
they have been able to provide that service, that advisory. I say it, I keep referring to advisory, but that partnership, that part of the partnership to make sure that they understand that at some point there may need to be an exit there. And what does that look like when the exit occurs? And obviously you've built this great product, you've built this great momentum, and it's worth something at some point, and you want to maximize its value.
I tell owners often, you really want to buy a business, whether you sell or not. You want to buy a business that can be sold at any point in time because you've optimized it. You've built it in such a way and it allowed the team to come around you and help you build it in such a way that it's ready to sell at any point in time and can attract, more offers, higher offers, attract more capital on better terms. There's all kinds of reasons to optimize a business. You can buy up weaker competitors. You can hire people and you're the best people and train them and retain them. You can pivot and go into geographies and offer products and services that you might not have been able to. So, whether or not a business owner gets in front of someone like me and says, "Hey, can you sell this?" There's great reasons for running your business and having a banker by your side.
That's
Well,
it.
let's take this topic of M&A a little further. I know you've been involved in some bank mergers and some leadership transitions. What can business owners learn about navigating change, whether it's, in a buying up a competitor or themselves selling?
Yeah. Once I think, my opinion, once you get over the euphoria of the deal, making a deal, whether if you're the seller, you know that that's it. You've exited. But if you're the new buyer, once you get over the euphoria of the deal, the real work of integration begins. And I
Mm.
cannot underscore the importance of culture, operating culture, and that's everything to how you present the product, how you present the brand. It's how you treat your team. It's how your team treats each other. And I think that culture is king in something, especially within the space I'm in. Work on culture from the standpoint of making sure that the bigger team, the bigger unit understands what the goals are, the ultimate goals are, how we're going to get there, and what it looks like when we get there, and then how do we share that success. And they take pride in that. And once you get the pride, you start creating a unique grassroots inside out flow. And
Yep.
if you're coming from the inside out, Bob, it's boundaryless. It's limitless as to what you can do because everybody's going for it and they're doing the things they need to do. They're making mistakes, likely making some mistakes, but they're learning from those mistakes. And that is part of the business cycle is the best educator of all times. You can't learn those types of things in a classroom. So I think the culture is king. It's your DNA. It's who you are. It's what you stand for. It's the legacy that you're leaving there. So I think that, when you're navigating that change, the X's and O's, the accounting, all those types of things, there are hard and fast rules as to what you're supposed to do there. And so you do have a roadmap from that perspective. A dollar minus 50 cents is still going to be 50 cents no matter who owns it or who's applying it. But culture, the way that product is delivered and creating those people who are willing to go out and say, I do business with Bob Tankersley because he's a good guy, but he's also got a good team behind him, and that's a good bank. Go see him over there, and he'll take care of you. If he takes care of you half of the same way he took care of me, then you're going to be just fine. And that's the buzz you want to get. Now, that doesn't work in every industry because it's not as touchy, feely as maybe
Yeah.
the financial services business is. I mean, to face it. But I think that in any time you've got a team of people together, if you've got more than two people, then you've got a culture, and you've got to protect that. And I think that's one of the most prized assets of a shareholder in the quest to get return on their investment. So having said that, I think that that's my big thing is culture. And as we were working through mergers and those types of things there, by the time when you arrive to the closing day, you already know through your due diligence what the investment should create for you, whether it's banking or whether it's, rocket ship building, whatever. You know how the dollars turned, and you've already made the risk decision in your mind. Now you've got to think about how can I execute now, and how I'm going to make this group of people execute on that principle so that we can all share in success together. And so I think it's completely two different avenues you have to take a look at. By the time you get to the closing, you've already done all you're going to be able to do, or you should have done all you to understand the business. But how do you light the fuse to go forward? And by participating and getting culture right, I think there's where the real return on investment becomes the reality. And how do you quantify it? Well, it's not culture is not going to necessarily ring the cash register as if I'm selling a product does. But I can tell you if you look year over year or some term over another term, that when you get the culture piece just right, it's ever evolving, Bob. But
Yeah.
once you get it where it needs to be, then you can tell a difference. I can quantify that to a certain degree in my business because I'm getting telephone calls from customers who are seeking me out to say, I had a really good experience in your wherever office, or I didn't have a good experience in your wherever office. But it's amazing to me from time to time how many people will seek me out. And I'm not, and I work in a bunch of different markets for our company, luckily, and have the privilege to do that. But they'll seek me out because they want me to know that something happened right for them. And so those folks are still out there. And on the flip side of that, there are people who vote with their feet. You never know they left. So I'm very grateful when someone who did not have a good experience will call me and say, or visit me, or email me, or whatever. And from my perspective, and I'll just go a little deep on this, I send a letter, to every customer we have on a quarterly basis. A shareholder gets a letter on a quarterly basis as well. And at the bottom of that letter is my email address and my direct telephone line to my office. And people will call that and they will talk to me. And I want to hear from them. I would not put that there if I didn't want to hear from them. And if you just listen to what they're telling you, they're giving you the answers to the test, you know. So
Yeah.
I'll digress back. Culture is king, and that's why I say that.
Now that's all well said. Lot of wisdom in that. And there's community banking at its best, folks. I appreciate that. So, from a lender's standpoint, what makes a business feel like it's transferable, bigger than its owner, rather than being so owner dependent?
Yeah, it does the business model, can it sustain itself without without the without that president or that main, in other words, let's make an analogy here. Can a football team still win games without its star player? And if it can, then what you have done effectively as the coach or the coaching staff, you've been able to train everyone to run at peak performance and empower them to be able to do that so that if you lose a key player or a peak performer, that it's not devastatingly bad to your business. Now there'll be a ripple effect to be sure,
Yeah.
but how do you handle that ripple effect and how do you recover from that if it even creates a situation for you? No team, no business can go through and just lose its main producer and not feel some sort of pain. But what you've got to be able to do is understand that's what it is, why they left or why this is the situation it is, what's the root cause of it. If there is a root cause, Did you diagnose it? Did you fix it? But also, have you been able to empower everyone around them to be able to jump in and then pull it through from that standpoint? And I think there's one of the things when you're looking at a business transition ownership. If I'm buying your business, Bob, I'm quickly identifying through my conversations with you in the diligence phase who the
Yes.
top performers are, how they're compensated, what are their hot buttons, what motivates them, what dismotivates them, what are the things that have not worked in the past, and I'm getting into my mind and into my management team. Let's identify who we need to make sure that we're pushing the resources to. And then the rest of the team, let's make sure that they get the same amount of resources and the same amount of training to create put them into the tier with those high performers. And let's do everything we can to make sure that every part of that organizational chart has the resources that they need to make sure that they have the ability to, from a succession perspective, Bob, to rise through the organizational chart if that's
Mhm.
what they choose to do. Also, that they've got the resources necessary to do so, and they believe that they can. And as the leader, what you'll want to be able to tell them going in as the new guy, I've been the new guy, and
Yeah.
so go in and it's really tell and then show. Whereas most leaders, in my opinion, have always been show, don't tell. But sometimes you have to tell and then show, and that makes it doubly hard because you've got to be able to prove, well, this is what I said I'm going to do, and then I've got to deliver on that. But if you know your business and you're in a good business and you're with good people, that's a natural occurrence at that point. It's just a matter of doing what you did to make you who you are to create that. And as a result of that, in that transition of ownership is to make sure that the people who are working in that, assuming that you're buying a business that's a going concern and there are people there or there are systems in place, make sure that you complement those things as opposed to coming in and if it's a failing business or something like that and you've got to make some changes, then you've got to make sure that you quantify why those changes are necessary and how they benefit everybody and how that will inure to the benefit of the team in total, and then get them to give you the buy-in that you need to be able to do what you need to do to create a non-performer into a performer if that's the case.
Yeah. Yeah. I noticed buyers always in the first conversation or two, and they word it differently, but they're trying to figure out as quickly as they can what happens to this business if something happens to this seller. And I think they also need to be thinking what happens to this business, to your point, if certain key people don't stay with us after
Mhm.
this transition.
Yeah,
Yeah, that they're especially private equity and sometimes strategic buyers. They're trying to figure out what does this business look like when we take over.
that's it. Hmm.
Well, Ryan, I don't know where we are on the spectrum of or the cycle of the economic situation here in the U.S., but we inevitably have downturns, right? So if we're due for a downturn, not saying we are anytime soon or whenever next one comes around, how should owners be preparing for an economic downturn or even without one, tightening credit conditions?
Yeah. Understand the economics that drive the business model that you're executing on. Understand if getting back to if you're running an airline, understand what fuel prices can do to your
Yep.
bottom line. Understand what a strike of workers could do. Understand what weather patterns can do. Understand all of these things and know that whether, to your point, Bob, whether it's in a downturn or not a downturn, you have to understand the things that will create headwinds for you, but also create the tailwind for you as well. And you've got to be able to know how to toggle back and forth and know what those levers look like so that you can be proactive in pulling those levers to make sure that any downturn that you've got is just a temporary switch in philosophy until it returns. And if it's not a downturn, just knowing how to tweak the business to lean it to the perspective, and I say lean it up, create the efficiencies needed to continue on that trajectory. Nothing beats a good old cash reserves, though.
Yeah.
It works in every case. When you earn a dollar, how much of that dollar are you putting back as a reserve for a loss of some sort? Banks do it. Most businesses do that, but a lot of times you see, I've got a dollar to spend on something that I want to do otherwise. But I think my opinion is that you pull back a certain piece of that for the rainy day. We've always heard save for a rainy day, and that is really that's where I'm coming from. There is just save for the rainy day to have that, because if you have the downturn, then you've got your cash reserves. Or if you have a no downturn, you're in a normal environment. Now you've got capital to fund something without going. And there's the creative advantage that you've created that advantage, that competitive edge I was speaking of earlier in our discussion today, Bob, of being able to be nimble enough to pull a trigger when you can, and you don't have to rely on anybody but your wits and your ability to go out and execute on that. Where everybody else is watching what just happened here, you're already across the finish line on that project. There's how you can be able to create future potential success for your company, whether you maintain that company for years on or you're preparing it for a sale in 5 years from now.
Yeah. It's kind of like you're talking what you're talking about here is kind of like a business that is more resilient than its peers. From a banker's perspective, and you've kind of touched on this already a little bit, but maybe go a little deeper. What does a resilient business look like from a banker's standpoint?
Yeah. Well, you hear the term fortress balance sheet, and
Yeah.
so what does a fortress balance sheet look like? Well, every industry will have a different definition of what it looks like, but I think the one common denominator is capital or cash reserves. And we've talked a lot about that, in our discussion today, but being able to have those cash reserves, what a resilient business looks like is one that's going to uh, a management team in place who understands a single common goal. It's whether it's written or whether it's discussed regularly, but it has to be discussed regularly and visited regularly to make sure that it's relevant, and instinctively a dynamic way of tracking it and being able to withstand and understand your business well enough to know that rainy days do come. They come
Yep.
in every business, and how do you get back to the sunshine? Nothing lasts forever, but you've got to understand how the ebb and flows of those things work. So if you're looking at building a resilient business, it's going to be setting yourself up financially to withstand that, but it's also setting yourselves up fundamentally and administratively to be able to know your business well enough to know that when it's time to make a move or pivot to one thing or to the other, or to make sure there's something that if there's something that's beginning to appear, a crack in the armor begins to appear, how do you patch that as quickly as possible? So it's not an event, it's more of just a bump in the road.
And stay close to your banker at all times. Again, not just when it's
Sure.
time to borrow money or borrow more
Yeah,
money, but
right.
yeah.
That's right.
So let's talk about your bank. As a community bank, you guys emphasize, I know, local decision making. Why does that matter for business owners? Wh- why not deal with a bank that, hey, we're going to send this loan package to corporate 3 states away?
Yeah. Thank you for allowing me to answer that question, because you're right. We have a slogan here that we've trademarked that slogan from standpoint of local bank, local decisions,
Mm.
and it's part of who we are. And from that standpoint, we've we feel like that we understand what's going on in the market that I'm sitting in. I can
Yep.
I can understand the conditions better. It may not show up on paper that they can do what they're saying, but I understand because I'm a mile away, or I've seen this happen. This is what happens in our town, but it doesn't happen in the town next to it. I can understand. I know the family. I may know the
Oh,
investor. I
that's
may know,
good.
yeah,
That's good.
knowing just know your customer, and they know you as well. It doesn't make it easier to obtain credit, because all, banks will typically, Bob, they all underwrite to a similar standard because it's just good business. But there are times when being local and being able to understand the business, understand how they make their money, and that type of thing, it really is a differentiator, to be able to, I can walk, from where I'm in my office, I can walk to and see businesses that are banking with us, and I can physically touch them. I can, see them. I can talk to the owners and those kind of things there. And I think that's the real differentiator there is the ability to talk to your banker and have the relationship that we've been talking about here today. That doesn't exist in every bank. It's a feature, it's a staple of a community bank though. And as a result of that, community banks are very interested in helping their communities. And there's a saying in our business that a bank's only as strong as the community that it serves. And as a result of that, we have a truly vested interest in making sure that what we're doing is helping business get from point A to point B without any hiccups or those types of things, where they're able to withstand them. So I think that we emphasize local decision making from that standpoint, that I can make a decision. I'll know Bob, and it's easy for me to understand if he's got a child in college and that he needs a car loan on a Sunday
About
afternoon.
five. I have five.
Okay. Well, okay. Let's just say one of the five calls and says, "Dad, my car's not cranking, and I think it's dead."
Yep.
And you got to get a car. The last thing in your mind is one of the last things likely in your mind is that, how I'm going to pay for this. I got to get my child back in a car, or whatever.
Yep.
And your local banker is going to be able to say, "Yes, Bob, we can get that. Help your family member, and here's how we'll help you help your family member." And that's I don't have an equal seat at your table, but I'm just one step behind you, just right over your shoulder. And when I need this guy, he's there for me. When I need this lady, she's there for me,
Yep.
and that's local banking, that's community banking, basically at its absolute dead level best is just being that partner when you need them, definitely when something occurs.
Yeah. Yep. I like that. That's important. They're the people that are with you in the same town. So this can work in the other direction. I mean, this is a two-way street, right? So there's some obligation on the part of owners to do things correctly. How can owners build stronger, more strategic relationships with their banking partners?
Staying in touch, making sure that your
Yeah.
banker understands what's going on in the business. Typically, I've always been of the opinion that I want to hear it before I see it on the street or in the newspaper, or hear it on the radio or on TV, or see it on the street.
Yeah.
That lets me know that there's something going on there, and we may be able to help with whether it's a bad thing. We can maybe help guide around that. If it's a good thing, we can help celebrate it. But I think one of the things that a business owner can do is just keep their banker up to speed on what's going on. Customarily, bankers ask for updated financial packages on a regular basis, maybe every year, just so that we can keep a feel for what's going on within the business, to make sure we have the risk properly graded internally, to make sure that there are no negative patterns or trends that are developing, or positive patterns or trends. And so coming forth with that updated information, whether it's asked for or not asked for, giving that information to, or allowing your banker to have that information, allows us to do what we were just talking about. You call me on a Sunday afternoon, right? I need X number of dollars to do something with fairly quickly. I've kind of got an emergency on my hands. Well, if I don't have any of your documentation, I will not be able to make as quick a decision, or as succinct a decision. If I've got I'm able to, if I have all of that information, or have seen it recently, or know it's there, it's just a matter of me going to finding it and reacquainting myself with it, to be able to say, "No worries, Bob, we got you. What do you need actually here? And let's put that in motion for you now," so that we
Yeah.
become part of your solution. We're not part of the problem you're trying to solve.
Oh, I like that. Yeah. Uh, all right. As we round out third and start heading toward home, we start talking about what to do today, or what to do tomorrow, or this quarter, or what must be done in the next 12 months. So, how about this question? If an owner wants to improve their access to capital in the next 90 days, what should they focus on first?
Full financial package,
Yeah.
having everything that a banker will need. If they've borrowed before, they know what that information is, and it's typically a up-to-date personal financial statement that's accurate. It's signed. It's within 12 months of of development. Also, the last 2 to 3 years of personal and business tax returns. Typically, if it's a commercial loan, typically we're going to want the tax returns of the entities where the potential borrower owns 20% or more of that business to be
I
able
was
to
going to ask.
capture
Yeah.
a debt schedule of all of the things they've got. Those are the types of things that a savvy business owner will have at hand, or have someone to be able to say, I need this package to give to my banker, or Mr. Banker or Mrs. Banker, here it is. It's on a safe portal, go out and get it, or hook me up with the CPA or whoever to get whatever you need. Those are the ways that you can maximize your ability to access capital. And 90 days is, and that's a in our world, that's a big window. Typically they're coming in 90 minutes, but or 90 hours, but they come, and that's the great thing.
Yeah.
So I don't want to discount that. But I would say that just always knowing where you are, where your footings,
That's
are,
good.
what's out there in case that day does come. Then it's just a matter of just turning it over. And again, the ongoing relationship that you have. Now, we talk about the relationship and keeping your banker up to speed and that type of thing there. So I want to clarify that to or quantify that to the degree where you don't need to go to see your banker every week. That's not what I'm speaking of, or even every month. Once a quarter, just speak to them. Say, hey, I'm just stopping by to say hello, or come by and see me when you get a chance, type of thing. Encourage your banker to come see you. We love making house calls, that type of thing there. But having said that, those are the things that you can do. Is just again, it's communicating with your banker and having a package that's ready to go when you need that. That really that speeds right to where you want to be as quickly as possible.
Yeah. I was thinking about that when you were saying a few minutes ago about an annual review package,
Yeah,
how important and helpful it would be for banker and business owner to talk at least quarterly.
yeah, yeah, exactly.
We got this rapid fire section that the audience seems to like, these quick questions. So first question, the biggest misconception that owners have about banks.
Why do you ask so many questions? Why do you need to know that information? Why is that important?
Yep. All right. One metric, financial metric, call it, that every borrower should know cold.
Their quick ratio, how quickly they turn their inventory.
Yep. One mistake that consistently hurts lending outcomes.
Not fully understanding their business and not having a strategic plan that has been proven successful, or that's realistic if you're starting up a new business.
That's a good one. All right. Final question here. If a business owner is thinking about growth or recapitalizing, or an exit in the next few years, what's the first call they should make to their bank this month, and why? What should they be talking about with you guys?
You're talking about, can I count on you to help me through this process by introducing you to the new buyer if they want to ask you questions about what the business looks like? Would you be willing to help me? And of course, privacy laws do exist, Bob, whereby you'd have to seek that permission, but
Yep.
or I'd have to. But if I'm given that permission, they want to come in and introduce me to that person, then I'll be happy to share whatever in the presence of, obviously, of my borrower there, to my customer, to be able to share that information there. What's the first call you make? You're just making sure that you've got everything in order, that you've thought through what you're doing. And if you have the privilege of time, then to put together a package that's going to answer a lot of the questions. But what your banker can help you put together those types of things there, and we will be able to counsel you as the selling business owner on what we would be looking for if we're going to reinvest in this business with a new borrower. So, what does that look like relative to the information I need to have on hand to give to that prospective buyer? And obviously, speed to closing is one of the things that you pride yourself on, and getting that done as quickly as you can. And therefore, a level of preparedness is where that is. So call your banker and say, in your experience in these situations, what do I need to have ready, or what do I need to be doing here to be ready? And the banker's not going to be able to comment on whether the product is a viable product in the future, those kind of things. But we are able to help you as the owner, selling owner of the business, quantify the cash flows and the types of things that they're likely looking at, because plainly, from our experience from a banker's perspective, a buyer, potential buyer is looking at an investment, and that investment is generated on cash flows and how quickly you can turn those cash flows, or if it's inefficient, how do you lean it up to where you can turn it, and what else can you do to that to make it bigger? So your return on investment, what does that really look like going forward? And therefore, how do you put it in the best light to be able to help that purchaser understand that? And your banker should be able to say, well, customarily, here's what we're looking at, the same things we looked at when we made you the
Yes.
loan. And are these things are still relevant and important? How the business creates revenue for itself is the very basis for the, the investment quality of that. So I would say, can you help me with quantifying that, Mr. Banker or Mrs. Banker?
I've been thinking about that this whole time. Again, I learn something new or have a new insight every time you and I talk, and that is if the business owner will let it happen, they can begin thinking like a banker just from a sheer analytical, discipline process. And that puts them in a better position when it comes time to sell anyway, because the buyer is going to be doing that for sure.
Yeah,
They're going to be
absolutely.
they're in a different, thinking about different things, but they're going to be thinking in that same analytical discipline kind of way. And if the business owner's already there because they allowed themselves to partner up with the banker all these years, so much better prepared for the exit.
That is it. That's it exactly. And to the degree where your banker can help you again, I would be remiss if I didn't indicate or mention that, from a banker's perspective, it's a very private, and I say private, it's a very confidential environment that we have the privilege of working in. So we take that very seriously. We don't give out trade secrets or secrets about the business. We don't discuss, you know, by design law. We don't discuss Bob's business affairs with the guy who's trying to buy his business. And I don't want to, but today we're talking a lot of, and I'm under the cloak or the assumption that we're in a private environment where that relationship exists for us to be able to have those type of, front end conversations in a private environment. So we're not sharing that information. Now, if you, as Bob, if you say, could you share what you know about my business with my proposed purchaser? I would say I'd be happy to, Bob. Let's talk about what that looks like so there are no surprises. And I want you to be with me when I do that so that
Yes.
if we begin to derail a bit or whatever, you can stop or whatever. But you control the conversation. I'll add whatever you'd like for me to add with the knowledge of your business that I have. We don't typically offer that information up by design, by law, by regulatory rule. You just don't do that. But I think that, as we've talked through our discussion this afternoon, you can use your banker in a lot of ways, and things we were talking about today fall under that privacy, behind that curtain until you, as the owner of that information or that consumer, say, will you share this for us, and I have you expressed what's written or whatever, you know, consent to be able to do that, and you're present to do that as well. And I think there's where the collaboration can be very effective.
Yep. Yep. Well said. Ryan, this has been fantastic. Great episode. Appreciate you being here. We've talked about the importance of having a business plan and the importance of having strong financial statements. And owners, if you're listening, please let the banker be your silent partner. Let them in. Let them help you run your business better, see your business differently, and get it to a better state.
Yeah.
Ryan, how can folks contact you to learn more about the good work that y'all at First National Community Bank do?
Well, our website, www.fncbank, so fncbank.com is a great place to find out who we are, what we stand for, gives a really good feel for what our product base is. Our geographic footprint is listed there with locations and those types of things there. And Bob, we pride ourselves on being a community bank that's dedicated to meeting the needs of the communities that we serve. And we take that very seriously. And culture, customer experience are the things that we really, really focus on.
Yep.
And we aim to get that right every time as much as we can. And as a result of that, we have a business model that works for us, and we've seen success in that. So I'm grateful to have an opportunity to be with you today, Bob. Thank you for it as well, and keep up the great work that you're doing too.
Thank you, sir. Thanks much. Folks, that's a wrap for today's episode of the Exit Teams podcast. A huge thank you to my guest, Ryan Earnest, for sharing his expertise and his insights. So if you're interested and you own a company and you're interested in seeing what excellent banking at a community level looks like, I suggest you reach out to Ryan and see how he can help. If you're a business owner thinking about your next chapter, now's the time to start building your advisory team. You can learn more in my book, Exit Teams, Build a Team of Advisors for Your Business Sale to Get a Higher Price, available on Amazon. And don't forget to check out exitteams.com for free resources, tools, and insights that can help you prepare for a successful exit. Until then, build your team, sell smart, and take control of your future.